I hope so.
I'm going to promote valuation now. Yeah, I've been working at Trucost for the last few years. We're a London-based research company providing data and insight to help businesses and investors to understand the economic consequences of natural capital impacts and dependencies. So by definition, through this work, I suppose we've had to lend quite a fair amount of thought to how to make the business case for better management of the environment. So today I'm going to go through how we go through with companies and how we set the context for action, help business to understand the relevance of megatrends to their organization, and finally provide you with an example of a kind of typical suite of actions that business can take to help better manage their environmental risks and opportunities. So the way we start with making the case is to remind our audience of the macro context. That is that the ultimate source of all economic capital is natural capital, and the world economy is essentially a subsidiary of nature and not the other way around, as we've been thinking for quite a long time. So this costing the earth figure from Accounting for Sustainability shows the criticality of the environment to the global economy. So the northern hemisphere, if you like, is total global GDP, which is around $60 trillion. And the southern hemisphere represents the value provided to the earth by the earth to the global economy, which is about $50 trillion. Interestingly, the red dot at the side, which is relative in size, shows the investment needed roughly to preserve the Earth's natural capital, and that's only around $90 billion. And yet, we're consuming about 50% more of the planet's natural resources than it can renew every year. And as we know, the direction of travel isn't promising, and there's an urgency to correct this. So what we have exacerbating the problem, obviously, these demand and supply side pressures that are driving increasing consumption of natural capital on one hand, and at the same time reducing the availability of that natural capital. So in turn, the economic effects of this are becoming clearer and greater as environmental costs become economic costs. And this is actually a slide from a recent presentation we did for a group of Indian investors. And some valuation figures that we've produced, or that we've borrowed from the World Bank and UNEP, start to give you an idea of the size of these risks that are inherent in the system. So we estimate, or the World Bank estimates, that environmental degradation in India in 2009 equates to about $80 billion or 5.7% of GDP. And similarly, the cost of air pollution to society, not paid by the polluter, was about $500 billion in 2010 due to lives lost and ill health. So we're looking at obviously very significant risks here. But generally, we're still depleting and destroying natural capital with little idea of the economic consequences. And this is largely due to the economic invisibility of nature and the fact that the value of the planet's ecosystems and biodiversity has not been taken into account fully and consistently in our economic accounting and decision-making systems. So in many areas, we have prices that reflect only partial costs, primarily because we have a design flaw built into the prevailing economic system. So essentially within, as the slide shows, so within the system, this incomplete information is giving rise to a whole series of both hidden costs and excluded values, or in more economic terms, negative and positive externalities. So I'm actually going to show you an example of these hidden costs and excluded values in the agricultural, food and systems, based on an ongoing study by TEEB, the Economics of Ecosystems and Biodiversity. So this study essentially seeks to make the business case for better environmental management through promoting systems thinking by bringing together the evaluation of ecosystems on one hand and the evaluation of agricultural systems on the other. And this is really important since the economic invisibility of the links between these systems is a major reason for the prevailing silo thinking that we have at present. So to run through this, obviously agriculture and food production depends on inputs from other sectors, such as fertilizers, fuel, machinery, as well as relying on ecosystem services such as nutrient cycling and water purification. So these are your invisible values, if you like. Clearly, agricultural production has many benefits, including providing employment and raising living standards, but also many social and environmental impacts, as we see here, such as health problems caused by pollution and unsustainable land conversion. So these are your invisible costs, if you like. And as we know, the problem is that these are not currently fully valued, properly valued, or paid for by the polluter. So TEEB essentially here is developing the business case for how the economic environment in which farmers operate is distorted by significant positive and negative externalities and a lack of awareness of dependency on natural capital, which is leading to increased fragility and lower resilience to shocks. But we find when we're talking to business in particular, it is useful to try and put monetary valuations around invisible costs and values, especially when making the case for their better management. So we often show companies' investments the absolute scale and distribution of externalities before helping them to understand their own contribution and exposure to these risks. So already a large body of research has been developed onto this topic, and we're finding it really helps business to understand their role in the system and mechanisms through which these hidden values may be exposed and the hidden costs mitigated. So about 2 years ago, the State of Green Business released a report assessing the environmental damage caused by the top 3,000 companies by market cap. And that concluded or estimated that if those companies had to pay in full for all that damage, it would wipe out about 50% of their profits. Similarly, we did a piece of work with the TEEB for Business Coalition 2 or 3 years ago, looking at the top 100 business externalities by region sector. So, for example, rice farming in Asia, cattle ranching in South America, and so on. And those top 100 industrial externalities alone were calculated to cost around about $4.77 trillion annually, which is about the GDP of China. So we're talking about huge systemic risk here. Certain sectors obviously more exposed than others, but to give an example of some of the top 5 sectors here, so for example, cattle ranching in South America, it was calculated that the environmental damage caused by that activity equated to about 19 times the revenue of the sector. So that obviously has serious implications for the long-term environmental and economic sustainability of that entire industry. So, particularly when we talk to business, all this can seem a little bit fluffy until you start considering how supply and demand side pressures can actually create drivers that impact business value. In other words, showing how unpriced natural capital costs drive adverse impacts on the macroeconomy, companies and investors. And there are multiple mechanisms through which externalities can and are being internalized by companies and investors. So here I'm going to give an example around how the market failures we've heard described can impact company performance, specifically via government intervention. So we start here with a recognition by policymakers of the economic importance of natural capital and the pressures it's under. And at a government level, this may elicit several different types of responses. So you may have the introduction of monetary policy, for example, reducing interest rates to stimulate economic activity after an extreme weather event, which may in turn boost or drag economic growth. You may have fiscal measures that are introduced, such as carbon taxes to fund clean energy, which may in turn result in inflationary pressures as energy prices rise. Similarly, we may have regulatory interventions, such as mandating emission control systems or standards in the automotive sector, resulting in higher capital expenditure costs. But all of this would be impacting the financial performance of companies and investor returns either directly or indirectly through additional costs passed through the supply chain. And this will ultimately lead to lower investor returns, potentially scenarios where you have stranded assets, such as in the fossil fuel industry, which may lower company valuation. So in this way, using this kind of thinking, we're finding that financial investors and companies are using natural capital valuation approaches as a basis for integrating new and valid cost dimensions into their existing risk assessment procedures. But I think building on those examples, it's important when making the economic case for action to show companies how natural capital should be seen as a new driver of existing risk categories that are already faced by any business, seen along the left-hand side. So here we have systems thinking yet again, but applied to internalization scenarios at a company level. The model you've seen up here is something that we've developed at Trucost. We call it a discounted cash flow model, and it seeks to assess the sensitivity of company value to potential natural capital risks. So this figure essentially shows how natural capital risk could impact on company financials if we take, for example, the automotive sector. We can kind of consider how these might play out. So in terms of operational risks, you could have higher supply chain costs, such as increased steel prices, leading to narrowing of margins as it pushes up the cost of goods sold. On the policy and regulation side, due to changes in legislation or voluntary commitments, this could mean costs associated with compliance or litigation, as we're seeing very starkly now in the Volkswagen case. Reputational risks to a company from participating in activities that create public perception, negative public perception, may obviously lead to lost revenues and brand damage. So again, the Volkswagen case, selling heavily polluting cars, has led to damaged brand equity and pricing power, and this will be played out on the balance sheet in terms of reduction in the value of intangible assets. On the climate risk side, including adaptation and mitigation risk from factors such as deforestation, global warming, shifting production zones, increased likelihood of floods and droughts. So again, in the automotive case, you could, for example, look at a case of crop failure in a particular rural area, which may hit agricultural incomes, which may then hit the car sales in a particular area. And then we also have market risks due to changing consumer preferences, resource depletion, and subsidy risks, where businesses may face risk from a loss or decline of subsidies. All of these can play out in different ways on the income statement, balance sheet, and cash flow, and eventually affect the share price. And this is something that I think is really framing it quite nicely and quite powerfully for companies and financial investors that we speak to. So, final slide. Essentially, by setting out these kind of scenarios that we've just talked about, we can create a business case for action with benefits in typically three key aspects of business performance. So business can and is capturing significant value by systematically pursuing the opportunities that natural capital management offers. They have to take a long-term strategic view of natural capital and build it into the key value creation levers that drive, firstly, returns on capital, secondly, growth or revenues, and thirdly, risk management. Obviously, each company's path to capturing value from natural capital is unique, but these underlying elements can serve as a universal point from which to get started. So the first thing that the business needs to do then is decide on a portfolio of actions to create value from natural capital related issues. So firstly, we have risk management. So this may include obviously regulatory management, mitigating risk and creating opportunities from regulation. An example of this is BHP Billiton, reducing exposure to regulation by reducing emissions. We have reputational risks, so companies getting credit for action through meaningful stakeholder engagement. A company that's very good at this is Novo Nordisk, who pursue very much a stakeholder shared value approach and have done some excellent work in generating value by talking to different types of stakeholders to their organization. And then finally, obviously, the operational risk management. So this is about managing the risk of disruptions from resource scarcity, climate impacts, or community risks. Again, a good case study here is Nestlé, who've been on their work on sustainable cocoa, particularly involved in developing communities, educating farmers, selecting sustainable cocoa beans, and so on. The second area is looking at this through the lens of return on capital. So you have sustainable operations. This is about reducing operating costs through improved internal resource management, so looking at things like water, waste, carbon. An example here would be Dow Chemicals, who invested about $2 billion 20 years ago to improve resource efficiency, and to date, they think they've saved around about $10 billion. Sustainable value chains, obviously important to look outside of the operations. This is about improving and managing and reducing impact throughout the supply chain. A great example of this is Walmart, who have achieved, since 2006, over $12 billion of global supply chain savings through their packaging scorecard and reducing packaging down the supply chain. And then finally you have green sales and marketing. So this is about companies improving revenue through increased share and or price premiums by marketing, for example, the resource efficient attributes of different products. And then the last area is around growth or revenues. So there's an opportunity here for businesses to understand relationship with natural capital and to develop new markets from it. So some are kind of building a better understanding of resource-related opportunity in new segments, new geographies, and developing strategies to capture them. So in the pharmaceutical industry, for example, we're seeing companies adopting flexible pricing for patented medicines in less developed markets. There's also an opportunity to widen the composition or change the composition of the business portfolio. So you can guide investment or divestment decisions at the portfolio level based on resource trends. So, for example, we're seeing waste management providers reinventing themselves as providers of integrated environmental offerings by adding waste reductions or waste-to-energy solutions. And then finally, the opportunity to innovate and develop new products. So we see, for example, steel companies, Mahindra Steel in the US conducting LCAs, reducing the impact of their steel production and then promoting that as a competitive differentiator to their clients in the auto sector. So, and I hope this has shown in some way how companies can kind of look to harness business value from environmental management. I'll now pass over to the floor. Thank you.
Thank you very much. That was well presented. The excluded values and the hidden costs, and you cited one finding in your presentation, and I repeat it again. If companies had to pay full costs of natural capital, it would consume half of their profits. And in some way, it seems to me that's the full message in one sentence. That's the problem we have to save. And I remember Richard saying before that business in a way is trapped. But this sentence also means that policymakers are trapped in a way, because it has to do with the way we finance our societies today, and it's about consumption and production patterns that we have to deal with, and that goes really to very profound challenges that we have to face. We're talking about our lifestyle on the whole. Thank you very much. So are there some, one or two direct questions? More than that. I'm starting with the lady, Marion Hammer from the Global Nature Fund and Bodensee Stiftung. Let's keep it short for the direct questions, then we have some time at the end of the session.
Yes, thank you. Direct question to Trucost. It's very important, or a big step, that companies start to evaluate natural capital, start to report on natural capital, but finally it should not be the last step. The last step should be to deliver something back to natural capital. And what are the companies thinking on this?
Well, I think that was a kind of subject that I got towards. I completely agree. It should never be reporting for reporting's sake. And I think I hopefully tried communicate some of the business applications of these kind of natural capital valuation approaches. I know Michael will come on to that with his case study later. Sorry, your question's gone.
To deliver something back to the natural capital.
Oh, yeah, sorry.
We heard
about
that reparation is so costly, and what should and could companies contribute to co-finance the reparation of natural capital which they used?
Sure, I think there's a variety of different types of actions that emerge from companies looking at their relationship with natural capital. So I've touched on some of them there. They tend to be around kind of risk management, identifying new opportunities, those two aspects, and then obviously communication and transparency. So that might be, in terms of typical actions taken, it might be companies investing in better practices in their supply chain, different sourcing patterns, developing a business case to invest in new technologies with different suppliers, for example. It might be raising the case for investment. So we're seeing the growth in innovative financing mechanisms such as green bonds. And again, companies are using natural capital valuation to justify the return on investment or justify the investment in these areas. So I mean, there's a whole raft of things going on, and it really depends. Typical actions really depends sector by sector. But I think also VLN I know she's going to be talking about the natural capital protocol shortly, and a key aspect of that is taking this field beyond just measurement. It's taking it into embedding and implementation, which are two critical steps in the natural capital protocol. So it's recognized that probably not enough action has been taken so far, but there are definitely steps in place to ensure that does start happening, that companies can start making sense of these figures, because I think that partly has been one of the issues as well. This work we've done here, linking it to financial accounts, I think that kind of thing's helping rather than just providing, social costs on their own, which aren't particularly business decision useful.
Thank you. There were two more guys. Yes, please. And some of them, yeah.
Jani Holopainen, University of Helsinki. I'm a researcher and conducting consumer research, supply chain research, and digital information technology research. And I want to underline some points that Tom in his presentation touched as well, and the moderator's comment as well, about the role of consumerism here and how all this information is actually conveyed to end consumers. And still, if we think that how the digital information technology, for instance, is used here, it's quite low usage of all the possibilities. We all are carrying like mobile phones in our pockets, but not actually using that all information or possible applications that we could have for making wise consumption decisions. So this also like from the low bottom of the value chain, it's all the way to the consumers, and that need to be addressed as well as a holistic approach.
Yeah, I think it's a good point. I think there's a real challenge around translating. There is challenge enough translating some of these risks and so on into business terms, but then translating them into terms that consumers understand is another thing altogether, and it's a huge area that I don't think has quite been nailed yet or quite been mastered yet at all. Well, we're far from it. So, but it's a very good point. How do you turn this into a narrative that a consumer will understand and respond to?
Yeah, by the way, in the research we have an application for that, so anyone who is interested to hear that, please come to talk with me.
And please allow me to say that, of course, consumers cannot compensate for the failures of politics and business. We should keep that in mind. Strengthen the consumers, but don't forget the responsibilities of the other parties in that field. I have two more questions now, brief questions, before we go on with our presentations. David Sturman from the CBD Secretariat, plus you upstairs.
Yep. It was a really good presentation. I just have a question, particularly in relation to one of the points that Jason Clay raised earlier. You're talking about the justification for investment, and it will cost, particularly any company, a small, medium enterprise who has fairly thin profit margins. But then Jason had mentioned earlier, but a lot of companies sometimes cut corners. So obviously there's a competitive pressure to be as cheap as possible. How would you, from Trucost point of view, how would you explain to a company that's operating on thin margins to justify making this investment when their competitors maybe aren't? And how do we resolve that issue?
It's very difficult, and I think, as you point out, this is an issue that does vary in significance from sector to sector. So what you said there reminds me of a piece of work that we're doing with a supermarket looking into essentially the natural capital risks associated with the sourcing of tomatoes. And it's all very interesting from an academic perspective, but then when you got talking to the procurement guys, these are guys that are incentivized to buy tomatoes at the cheapest price on the spot every day. And this is a challenge when it comes to buying commodities where you have very little visibility of where they're coming from. You're buying them in such volume that the chances are you might not get stung on a day-to-day basis. That's an issue. Where it's easier to bring in is with companies that are involved in larger infrastructure projects. So, for example, you could be talking to an airport or a waste treatment facilities where they will accept that over the lifetime of that particular asset, you'll have your capex and you have your opex, but you're likely also to incur costs that are not yet foreseen relating to the environment. And it's easier to argue the case that they would be internalised over the lifespan of a particular product rather than day to day with buying different commodities. That said, there's work with companies, big high street fashion retailers, very high volume, low margin, that are taking very seriously their dependency on cotton, for example, and where that's coming from. The very famous case of H&M being stung 2 or 3 years ago because they were exposed to a failure of a cotton crop, which pushed the price of the cotton up. They couldn't pass that on to the consumer, and that led to, I think, a 30% dip in profits, or something like that. So, in their case, that's a case of costs internalising, and now they're taking action in terms of potentially vertically integrating further down the supply chain, securing particular suppliers in sustainable areas on long-term contracts and so on. But yeah, it is harder with the companies which are buying in bulk and buying quickly.
Thank you. And one more question upstairs. Yes.
Good morning, thank you. Matt Roberts from Interserve PLC. We're a global construction and support services company. A question to both Tom and Richard, really. 2 thoughts. One is that is it the valuation process that is more important than the value at the end of it? A bit like no plan survives contact with reality, but the planning process is what makes us more resilient in our ability to cope with change. And I think we spend a lot of time using big headline numbers that come out of valuation processes, which, to be honest, don't mean anything to anybody. But the valuation process itself is a really important way of understanding the significance. And a second thought is about, we have leapt very quickly to wanting to use financial accounts as an analogue for the complexity of natural capital. And I wonder whether or not we'd be better off finding something else to talk to people about this very complex environment. And for me, I've now started talking to people about the weather. The weather's a great thing to talk about. Everybody talks about the weather. But the weather is a product of lots and lots of complex interreactions. But we don't reduce it down to a single number and say the weather today is 27. But we all understand what the weather is, and we all have lots of metrics within the weather that we may use to emphasise a point. But it's a really common and easy way to explain to people what complexity looks like, is if we talk about the weather. We can measure rainfall and sunlight and wind direction and speed and all these sorts of things. Lots of phenomenally clever science and really good processes. But actually, at the end of the day, we don't try and turn the weather into a number. And maybe we need to be taking that approach to things like natural capital and social value and so on.
Yeah, good question. I would agree with you that valuation should not be the end game. But what I think it's helped shine a light on the companies we work with is the system and identifying the linkages between between their business and the outside world. So I talked earlier about these invisible costs and values and so on. Whether or not you value them, you'll be I mean, the majority of companies we speak to aren't thinking in a way in that systems perspective. So I think it's been helpful just from that to help them understand their impacts and dependencies, whether or not you value them, and also considering qualitatively, how they might impact on their business. Do you want to?
Yeah. Hi, Matt. Now, I completely agree. I think the process is probably as important as more important than the output, because just to think about some of the things I was saying is, you then in the process of valuation you have to think about, well, whose value, and what if somebody doesn't value it like I value it, and all those sorts of things. And so if you raise the process in importance, you actually raise the consciousness of the act you're doing, and I think it can play to that systems thinking, because you're having to think about all the connectivity. And I couldn't agree with you more about accounting, particularly because we all use financial accounting and then we all talk about disclosure. And the point is, unless you're actually doing something, you haven't got anything to disclose other than what you've made up in the PR department. So I would say that if we were going to use accounting imagery, let's use management accounting, which is more about information in different shapes and sizes, and it's not as brittle or as kind of two-dimensional as financial accounting. And yeah, I mean, other ways of thinking about it are, very illuminating. But let's not be prisoners to certain processes. Yeah.
Thank you very much.